Breaking news coming out from Bank of America, just reporting its earnings. Wilfred Frost is here, and he has those numbers for us, too. Wilf, what can you tell us?
Hey, Becky. So we've got a inline revenue, $22.2 billion. That's where the forecast was. A slight beat on EPS, 82 cents a share, versus a forecast of 76 cents a share. Seeing a tough quarter. It's been tough environment for the banks. It's trading lower off the back of that. Let's break through some of these individual line items. So net interest income, absolutely key for Bank of America. Interest rate sensitive bank, of course, $11.5 billion. That's a little ahead of forecast for $11.35 billion. The net interest margin was 1.67%. So that's a 1 basis point decrease from last quarter, which is a bit of a surprise. But either way, it's a beat on the net interest income line. And loans look pretty strong here. It's a big question, of course, going into next year. Their loan growth, total loans up 8% when you strip out PPP. So it'll be interesting to hear if they feel like that can continue in the year ahead. Now, key, of course, this quarter for the banks has been expenses. Their non-interest expenses come in at $14.7 billion. That's broadly where people were expecting. It's up a couple of percent or a couple $100 million from last quarter, but they guided to that in early December at the Goldman Sachs Financials Conference. And there's a line here that suggests they're saying 2022 expenses should be flat on 2021. Now, that should be seen as a relative victory compared to what we've seen from some of the other banks, some of the factors that have really hurt, for example, JP Morgan's numbers and Goldman Sachs yesterday. We'll need more color on that when we get to the call. But flat expenses year over year should be seen as a win when we get to that point. And then in the capital markets, similar to the others. So trading a little bit lower year over year for fixed income. Theirs is actually flat year over year for equities. That's quite good. And investment banking very strong, $2.4 billion. The forecast $2 billion. That's up 26% year over year. They've got a fractional benefit in the provision for losses line when there was expected to be a fractional provision. So that's a small item, but nothing too significant. I'd say the headline here is loans look strong. Got to hear more about that. And if expenses are indeed flat year over year, the guide for the year ahead, then that probably will be taken well by the market, and the stocks recovered a little bit.
Yeah, and I think that is probably the key issue. You know, some of those comments from David Solomon yesterday at Goldman Sachs, well, just really talking about inflation being out there, and that probably has people wondering what that means for expenses down the road for companies like that, too.
Yeah, different type of expenses for Bank of America for the most part than for Goldman. For Goldman, it was significantly in the comp, the pay and bonuses area. For Bank of America, it's been a sort of long-running cost-cutting move that has been put on hiatus during the pandemic, and people want to see if they can get back to that kind of keeping costs under control kind of part of the second half of Moynihan's tenure. And I think if they're going to say that this quarter was basically in line with where they guided in early December, we didn't get some wild card surprise like we did get for Goldman and JP Morgan, and if they're going to say it's going to be flat in the year ahead, that could be seen as a positive. Loan growth was good. Net interest income was good. But the net interest margin was essentially flat or down despite rates rising Q3 to Q4. So, again, guidance on that area in light of all these rate hikes we've seen will be important.
Shepard Smith here. Thanks for watching CNBC on YouTube.